Hello and welcome to our monthly update. I'm Hugh Holden and I'm joined today by Portfolio Manager Adam Bowe. Adam, bonds have been in the news lately as we've seen growth rebound, inflation expectations rebound and bond yields rising. So let's spend the next few minutes talking through what's happened and what it means for bond investors.
Yeah, well, if you look back at timing, the rise in yields started to materialise around the fourth quarter last year. So I think the timing is important because that was a timing when vaccines started to be approved by governments around the world. In fact, the US and the UK started their vaccination rollouts. So I think the visibility that the market investors started to have on coming out of the pandemic was important, bolstered expectations of growth and inflation. So I think that was really the key driver and the key timing of it. And when you look at the components, 3/4 of that rise in bond yields, 10-year yields in Australia and the US rose by over 1%. 3/4 of that was rising inflation expectations, and only a very small part was a rise in real yields. So it was a very healthy normalisation of interest rates. And you saw that it was in the context of positive returns in equity markets and risk assets. So we sort of characterise as a healthy normalisation of interest rate levels. And I think it's always important to put it into context as well in terms of bond returns. I think rising yields always comes with sort of hand-wringing and fear from investors about what that will mean for returns on bond portfolios. I think this is a really healthy case in point that often that fear is worse than the reality. If you look across our suite of core bond portfolios, they've actually all had positive 12-month returns to the end of March. So that fear is often worse than the reality. So when we put it into context, I think it's just been a very healthy rise in interest rates to more normal levels.
Yeah, and just very quickly on the 12-month experience for bond investors, because as you rightly said, people can become quite fixated on rising bond yields, but how can a bond fund generate positive returns even as yields are rising?
It's a good question. The first point is that bond funds aren't just comprised of 10-year sovereigns. So as we said, 10-year sovereign yields went up by, say, 1% in Australia and the US, but bond portfolios are comprised of bonds of varying maturities and credit profiles. So they have a lot of natural buffers in them to protect from rising rates. So 3-month interest rates hardly went anywhere because central banks are anchoring them. Corporate bonds outperformed because growth expectations, profit expectations improved and credit spreads came in. And of course, as interest rates are going up, you're reinvesting at higher levels of interest rates. So there's a lot of natural buffers for a bond portfolio to perform reasonably well, even in rising rate environments. There's a wealth of tools for active managers like ourselves to deploy as well to protect investors from rising rates.
Yep, fantastic. And so just coming back to something that you touched on earlier, one of the drivers of rising bond yields was increasing inflation expectations. Yep. And there's been, I guess, a variety of views on where inflation's heading from here, out in the market and in the media, with some commentators even calling for significantly higher inflation or to the point of runaway inflation. So what's our view on that? And do we think those fears are well-founded?
Look, we're definitely going to see higher inflation prints over the next couple of quarters. And there's a couple of things driving that. We've seen higher oil prices and energy prices. It's going to be a driver. But when you're looking at 12-month numbers, a lot of the deeply negative prints from CPI or inflation last year start to roll off. So remember, free childcare in Australia. We had a very big negative print in the second quarter as a result of that. So as those negatives roll off, the 12-month window looks very positive. So as we go through this year, we are going to see some higher sort of year-on-year levels of inflation, probably towards the top of a lot of central banks' bands, target bands, but it's going to be transitory. A lot of it's optical as the negatives from last year roll off. By the end of this year, and as we go through even next year, we think we're still going to be comfortably below central bank targets for inflation. So for the next couple of years, apart from a sort of transitory move higher through this year, below central bank levels or targets. And really to see a sustained rise in inflation, we need to start seeing wage pressure. And to get wage pressure, you need tight labour markets. A tight labour market in Australia is the unemployment rate somewhere in the 4s. We're currently near 6. So we're a long way from seeing sort of tight labour markets and wage pressures. And certainly for the next couple of years, this year and next year, our expectation is inflation to average comfortably below central bank targets.
Okay, and probably fair to say central banks would be somewhat happy to see inflation actually get to their target ranges, given that they've undershot for quite a period of time.
That's right, and they've all kind of adjusted their policy now. They do want to see a period of sustained inflation above their target or at the top of their target band. Certainly something they'd be comfortable with, but not something we're expecting for the next couple of years.
Yeah, perfect. And so you mentioned at the start, we've seen yields rise driven by stronger growth in inflation expectations. We're not too concerned about runaway inflation. In fact, we think that it should stay relatively under control over the next few years. So I guess the final question, and one that we get from our clients, is where to from here? As you mentioned, we've seen bond yields rise by over 1% since August last year. So where to from here? Do they continue to rise? Is most of that move behind us? What are our expectations?
So I think we've got a fairly range-bound outlook for interest rates now. As I said earlier, we think the recent move higher has been a healthy one, and we're back to more normal levels. Certainly we're not at abnormally low levels anymore. You know, when you look at 10-year yields in Australia and the US, we were here in 2016. We're no longer at pandemic abnormal levels. And as we emerge from the pandemic, we're not expecting to see this sort of abrupt move higher and to be structurally higher levels of interest rates than we were before the pandemic. So we're getting back to levels that are more normal. We think we're at a level now where the near-term outlook's fairly range-bound. And as I said, there's been a very healthy rise and yield and carry on bond portfolios have come back to fairly attractive levels. So certainly when we look forward, bond portfolios, core bond portfolios will be able to perform that dual role of being, a good store of value and provide the diversification benefits for broader risky portfolios.
Perfect, thanks Adam. Well, thank you for your time and thanks for joining us. Hopefully you found that useful. If you do have any questions or would like any further information, please speak to a PIMCO account manager or visit our website at pimco.com.au.